The next question is, what about subpart F? Now, let's put up here at the top, which we put up earlier, or I should say last week, a box for Bermuda, which we will place here, and we will have the various companies, the manufacturer, the Swiss company, the Dutch company, the China distributor, and also the company, let's say that we do decide on a company in Singapore. We decide to have all of these owned wholly, 100%, by a Bermuda company. Now, all of these companies in the network, there's probably a couple that I didn't mention as we went through it, but all of these companies are eligible entities. So we have a choice. Do we treat them as disregarded entities, or do we treat them as foreign corporations? Now, for purposes of discussion, we'll assume that we have decided that Bermuda will, of course, be a corporation. And why do I say a corporation? I say that because we want that line. Remember, unless we have a foreign corporation, we don't have any potential for deferral. If we treat all of these companies as disregarded entities, if we don't draw that line in there, then there's no deferral because all of the income and expenses just flow through to the U.S. owner. So if our goal is to have low taxed earnings overseas and to keep it deferred from U.S. tax, then we have to have that line drawn. We have to have a foreign corporation. So that's why Bermuda very clearly has to be a foreign corporation. So that's our decision under the check-the-box rules for that. Now, what about the others? The manufacturer, the owner of the IP, the Dutch company, the Chinese company, office in Singapore. Now, I'll treat the Chinese company differently, and I'll explain why in a moment. But let's assume that all of the others are being treated as disregarded entities. But this one over here will treat as a corporation. Now, if all of these are disregarded entities, do we have any royalty, for example, between the two from a U.S. perspective? We, of course, have a real royalty between two real legal entities. The Swiss company, the Dutch company, they are real companies. No question. But are they, for U.S. purposes, is there a royalty agreement that we would respect?
For tax purposes.
Yeah, for tax purposes, it just doesn't exist. Because if I take something from one pocket and put it in the other pocket, I haven't done anything that has any economic reality. And if the Dutch company and the Swiss company are both disregarded entities, it means that Bermuda has taken something from one pocket and put it in the other pocket. So there's no royalty from a U.S. perspective. What about the payment for the contract manufacturing to the Malaysian company? Again, that service fee is ignored. From the standpoint of the income and expenses of the Bermuda company for purposes of U.S. taxation, all you look at is that, gee, it has expenses for manufacturing an asset.
It will be allocated to the source of manufacturing activities, right?
You're talking about source of income.
I mean the expense.
Well, the expense is, okay, legally within the Malaysian company because it really exists, but when we fill out our U.S. tax return and prepare the appropriate forms, which, again, I do recommend that you look at some of these forms just to see what they look like and what goes on them. In this case, it's Form 5471, and again, these forms are on the course website, so I suggest you look at them. The Bermuda company will be treated as having effectively a branch in Malaysia, which is conducting these activities and expended this much money on manufacturing a product. And remember, we said that some very important manufacturing oversight and so on is going on inside the Dutch company. So some of the expenses of people in the Dutch company will be part of that cost of manufacturing the product. So all of that just gets merged together within the tax accounting for the Bermuda company for U.S. tax purposes. Now, this may be a terrible nightmare from the standpoint, if you're a bean counter, trying to keep track of all these things. Nobody said that was easy, but that's what has to be done. And accounting systems are set up to accommodate these things so that you do, in fact, have the numbers you need eventually for tax returns. Yes, Peter?
Isn't there some kind of cost associated with the Malaysian entity ensuring that the contract manufacturers don't steal the technology and have quality control to protect the trademark and everything?
Okay, yeah, that's not in this situation, that's not the Malaysian company, that's the Dutch company. Its personnel, yes, are specifically seeing that the unrelated contract manufacturers are controlled, not only, yes, with regard to quality of the product and, seeing that they're doing it right, but yes, from a standpoint of protection of the intellectual property. Absolutely. How do you think much of the cell phone industry and the chip industry sort of ended up in Taiwan? You think it's because they came up with all the ideas in the first place? No, they were contract manufacturers, and they learned over time, and they sort of gradually, gained a lot of technology, which they do not necessarily pay full royalties for nowadays. I see the gentleman in the back smiling. You found this with your own products?
I've observed this over the years, yes.
Okay. So anyway, the point is, yeah, Peter, you're absolutely right. Protection of intellectual property is protecting the crown jewels. And one of the things while I was in China talking with clients about was, are you in fact taking that seriously? Because China for a long time has had a very, very strong belief in getting technology, whether it's legal or otherwise. So, yeah, it's a real issue.
So if you have the office in the Netherlands buying products that are manufactured in Malaysia and then selling them to China, wouldn't the branch rules kick in there somewhere?
Excellent question. Excellent, excellent. You're anticipating exactly where we're going. Yes, the branch rule, which you hopefully remember exists in the subpart F area. The branch rule is found in 954D2, and in the regulations, I think if I remember correctly, 954-3D. And the branch rule, well, let me ask you, Kristen, what do you think? Do you remember enough about how the branch rule works to know whether we have to worry about the branch rule when, yes, there is, so to speak, the home office of Bermuda, or let's say operating through the Dutch company where there's some sales activity. There's manufacturing over here at the branch in Malaysia. Do you remember as to how you test when there's a manufacturing branch? Remember, the general thing was that under the branch rule, if the use of a branch gives the same effect as if there were a subsidiary, and the way that effect is measured is if there's a reasonably lower tax rate that's achieved through the use of the branch. I think the example we gave when we talked about this was if you had an Irish company with a manufacturing branch in Germany. Germany had a relatively high tax rate. Ireland had a relatively low tax rate. And we found that under these rules, we had to take the branch in Germany, treat it as a separate company for purposes of calculating subpart F income. And we then said, okay, because of the need to treat it as a separate company, we had point of origination, point of destination, outside the country of incorporation, and the related parties involved. So, gee, that's foreign-based company sales income. Now, any ideas to how we decide whether the branch rule is an issue here?
Well, isn't Bermuda's tax rate pretty low?
Yeah, 0.
If it's 0, then it's definitely going to be lower than Malaysia's.
Okay, but what's the effective tax rate on these sales? Are we looking at Bermuda or are we looking at the Netherlands? We said the Netherlands has a 25.5% rate, if I remember correctly. We said that Malaysia has a 25% rate. We said that even the Chinese company, China has a 25% rate. If we're comparing under the manufacturing branch rules, the percentages in the country that's making the sale and the country where the manufacturing is taking place, well, gee, we don't have any reduction of tax. We don't have any reduction of tax. So we end up not being hit by the branch rule. And you're asking the absolute right question.
So does it measure by the compare, let's say, of the parents rate in branch rate or the whole system?
Well, if you actually want to read through the branch rules, they are absolutely miserable. But economically, what they get to is you compare the tax rate in the country where the sales are made to the tax rate in the country where the manufacturing is. And what the rules are looking for is if the tax rate in the country of manufacturing is too much higher than the rate where the sales are being made, then you have to treat it as the manufacturing branch as a separate company, and you end up within the sales activity, the sales income that's earned, you end up with subpart F income because point of origination, point of destination outside of the country of incorporation, and a related party involved. But if you are able to sidestep this branch rule problem, which this effectively does, then what is the result? Well, the result is that the Bermuda company, under U.S. tax concepts, is manufacturing a product and is selling it to unrelated parties. If the branch rule does not work, if the branch rule, does not cause a problem, then there's no foreign-based company income because there's no related party involved. The Bermuda company is doing everything. Now, I said let's leave the Chinese distributor as a separate corporation. Now, you of course can say, but wait, the company is incorporated in Bermuda, and the manufacturing is in Malaysia, and the sale is into China. Well, that's point of origination and point of destination outside the country of incorporation, and a related party's involved. So isn't that foreign-based company sales income? Well, remember, there's a manufacturing exception. There's a manufacturing exception. As long as the branch rule is not a problem, because the Bermuda company really is manufacturing on items produced in Malaysia, there's no subpart F issue. Now, what about the items that are purchased from the unrelated contract manufacturers? Now, in the case of those items that are, let's say, sold to China, those items are not, are not physically manufactured by the Bermuda company because it's an unrelated contract manufacturer. Well, if we remember back to our definition of manufacturing in 954-3A4, there's a few different items, and one of those items is exactly this situation, that if the Dutch company here, in other words, if personnel that are real employees of the Bermuda company, and again, they are in a U.S. sense because of the disregarded entity status, if employees of the Bermuda company are conducting all of these important functions with respect to a contract manufacturer, that will constitute manufacturing by the Bermuda company. If you remember, there were essentially three methods. One was sort of a qualitative method. A while back, it was a tree. Now it's paper. That's a real transformation. Then there was a sort of a quantitative test of, maybe it looks similar, but you had a certain defined percentage of the manufacturing costs that were factory burden and direct employment, employee salaries, for example. And then there's this third one, which is this situation of contract manufacturing. This, I hope, gives a flavor of, in a sense, how you have to think about the environment that we're in. That you really can define the boxes, you can define the contract relationships, and you do it with regard to local law in the various countries in order to minimize the amount of tax in each country. And at the same time, you obviously pay attention to subpart F or the PFIC rules or 482 or whatever it happens to be in order to maximize deferral from the standpoint of the U.S. taxation. I certainly suggest those of you who are particularly interested in this look at testimony and the papers in connection with that from some July 2010, I think it was Ways and Means Committee hearings, which focused at this kind of thing. And if you're interested in more detail, it makes very, very good reading, and I think will help your understanding.